My name is Javier Salinas. I'm a managing director with BPM based out of San Francisco and part of the international tax practice at BPM. Today, our presentation is on the international tax impacts of COVID-19. So the impact of COVID-19, the pandemic has been profound, and as uncertainty about the economic impact persists, the disruptions that we see is taking a toll on business supply chains and operations. And in addition to these supply chain disruptions, there's a wide variety of industries that are also seeing reduced customer demand, limited operations and output, decreased liquidity, and significant changes to how business is conducted. For example, having to work from home or holding virtual meetings. And as governments across the world are challenged to release legislation and guidance addressing some of the most critical needs of the citizens and locally based companies to ensure resilience for businesses, they've turned to tax provisions in many cases to alleviate some of the economic hardships and free up some of the cash resources that to be made available. So this webinar is intended to address some of the relevant guidance and raise practical considerations resulting from the supply chain disruptions and other consequences of the COVID-19 pandemic that any multinational business will face to some degree. So joining me today are a number of colleagues and practitioners from various countries to truly give us the international perspective on what we're seeing in different geographic regions and practices. So on going through the list here of speakers, starting on the left column after me, my colleagues from BPM, we've got Sven Joost, a partner and leader of the transfer pricing practice at BPM based in San Jose. Also joined by Frank van Hulsen, managing director of international tax based out of San Jose as well. And from the UK, firm of Wilkins Kennedy, we have Steve Jacob, partner in the tax and advisory practice based out of Kent, United Kingdom. On the right column, we've got Andrew Beauvais, a tax lawyer with the firm of Beauvais Montero and Associates based out of Madrid, Spain. Laurent Domergue, director, tax and VAT specialist based out of Paris, France with GmbH Walter Alenial. And then based out of Montreal, Canada, from the firm of Barcelou, Lawson and Rowe, we've got Sheena Bassani of counsel and transfer pricing expert, and also Sebastian Rowe, partner, the transfer pricing and tax controversy practice. We will just go through generally the agenda. For the next section, the second section of the presentation, we'll turn to some of the tax concessions and extensions raised in the various jurisdictions. After that, we'll turn to the transfer pricing issues and some of the practical considerations for applying the arm's length principle during an economic crisis. After that, we'll turn to the taxable exposures or so-called permanent establishment concerns and country-specific guidance. And then last, we'll open it up to a question and answer section for any questions from the audience. And the following slides, we will go over some of the topics of state sales tax and VAT, audits, controversy, corporate income tax, and other taxpayer relief before addressing items of mutual agreement proceedings, advanced pricing agreements, and country-by-country reporting. So with that, I'll turn it to Steve for the UK measures.
Thank you, Javier. Well, the UK was one of the first countries to announce significant economic measures to protect its economy as the implications of COVID-19 manifested themselves. And as is usually the case with these things, that was more by luck than design, as we had our normal annual budget scheduled for the 11th of March. That's a long-standing date. It had been in the diary for a long time. And the Chancellor had to do something. He'd looked pretty silly if he'd gone ahead with a normal domestic agenda without recognising the significance of what was unfolding. And now our budget speech is normally an event of great pomp and ceremony, a packed House of Commons, a symbolic red box briefcase. And to cap it all, we also had a very new Chancellor of the Exchequer in place, Mr. Rishi Sunak. He'd only been in the job for a few weeks. Boris Johnson, our Prime Minister, had fallen out with the previous guy. And we knew nothing about Mr. Sunak at that point, or his politics, or his economic views. We wondered, would he take a cautious first step while he found his feet in his new job, or would he do something more significant to make a splash and announce himself? But looking back, that date, 11th of March, it seems like a lifetime away now. I mean, the run-up to our budget was dominated by normal domestic tax issues. We were trying to get our clients to complete transactions where we could because we feared a particular relief was going to disappear for capital gains tax. Clients were asking, should they be stuffing money into pensions for similar reasons, all normal domestic stuff. And then we had this announcement of £300 billion of stimulus via loans and payroll support schemes, which rather took our breath away at the time. But looking back now seems like a drop in the ocean. But it really was a first major sign of how significant this event would become. So what did he announce? Well, actually very little in the way of tax itself. An automatic VAT deferral for payments was the only deferral as such, and no corporate income tax deferral. And crucially, whilst telling us all we couldn't go into our offices to go about our business, there was no deferral or relief for the administrative burdens of dealing with your tax. So returns and reporting are all due as normal. And that includes the international tax aspects, so transfer pricing, country by country reporting, etc. Next slide, please. And instead, we had stimulus in the form of direct support for employers' payroll costs, and several different loan schemes were underpinned by government, although, of course, those loans need to be repaid in time. Some personal tax deferrals for individuals who are in business as sole traders or partnerships, but again, nothing for corporate tax. And with that payroll scheme, which is costing a lot of money, it remains to be seen how successful that will be. And are we just deferring the inevitable? Only time will tell in that regard. And now I'm going to hand over to my colleague Andrew, who will comment on the position in Spain.
Thank you, Steve, and hello to everyone. Yes, Spain also has been hit pretty hard with the COVID-19 crisis. From a general overview, what we've seen is there's been a lot of activity from a social security and labor point of view, meaning a lot of short-time work, in certain cases even layoffs. The government has stepped in, trying to release and trying to alleviate any negative consequences in that sense. Also from a financial point of view, the government has provided some government-backed funding up to 80%, which is also trying to incentivize the economy. And then what is going to be the subject of this presentation, the tax measures from the Spanish government. In this sense, we like to classify them in three main groups. First main group being payment deferrals, so cash measures. In that sense, we classify them in two groups. Number one, what has to do with self-assessment taxes, and number two, taxes assessed by the tax authorities. In the self-assessment taxes, the measures are only focused for small and medium enterprises, meaning companies with a turnover under 6 million. So companies with a turnover above 6 million cannot benefit from these beneficial measures in tax deferrals. What are these measures? Basically, these small and medium enterprises can postpone VAT payment, withholding tax payments, and also corporate income tax installments. This is something new because until now, these were taxes that could not be postponed. And these can be extended up to 6 months. The first 3 months interest-free, and the following 3, there is a 3.75% interest. Customs may also be postponed for 6 months, but there has to be a guarantee of at least 30,000 euros. And then, as we said, the assessments carried out by the tax authorities, these can be postponed regardless of the size of the company. The other big group of measures, of tax measures, has to do with filing and compliance obligations. For this, we have to again distinguish between federal or national taxes, that would be personal income tax or corporate income tax, and more state or let's say regional or town, city, municipal level. Because in Spain, the regions are allowed to govern wealth tax, stamp duties, inheritance and gift tax. The main idea being that at a federal level, there has been no changes in regards to the filing obligations. Companies and entrepreneurs are still obliged to file on the ordinary deadlines, whereas at a regional and local municipal level, There is a big variety of measures, and there's been postponements of 2 months, of 1 month, until the state of alarm is finished. So keeping that in mind, we'll have to see, depending on the tax that is involved, what measure we can benefit of or not. And the third big group of measures in Spain has to do with tax audits and litigation. Basically, this affects the statute of limitations. Any tax audit that was started before or during is suspended during the state of alarm, during the lockdown. So now the statute of limitations that usually lasted 4 years will now last 4 years plus 2 months and so days regarding the lockdown. For appeals and other types of litigations, this is all postponed until the end of May. After that, 1st of June, the normal counting days will proceed. This is all for Spain. I'm going to hand it off to Laurent, our colleague in France.
Thank you, Andrew. Hello, everybody. So regarding France, I would like to address 3 topics today: VAT, corporate income tax, and tax audits. So VAT is a major source of revenue for European member states. And it's the first source of revenue for the French government. So this is probably why, unlike other European jurisdictions, French government rejected any possibility to defer or cancel VAT payments. So our government made quite clear that priority in terms of relief measures has been given to direct taxes with direct impacts on businesses, not on those taxes affecting final consumers such as VAT. Government also stressed that unlike social contributions, VAT follows the level of activity of a company. Basically, if there is less activity, there is less VAT to remit to the tax authorities. During the lockdown period, we know that those companies that have been claiming VAT credit refunds can benefit from fast refund procedures. We know that tax authorities are really committed in speeding up VAT credit refunds, which is quite new in our country. And this is quite a significant relief measure for businesses in terms of cash flow. Unlike VAT, businesses that are facing financial difficulties can defer payments of corporate income tax and other direct taxes for a 3-month period without justification and without penalties. Now, as an additional measure, cancellations of direct tax liabilities are also available, but only on a case-by-case basis for those companies that are facing extreme financial difficulties. Another interesting aspect about France is that for large corporations, deferments and tax rebates are available only if the French entities commit not to distribute dividends in 2020. Final aspects now for France regarding tax audits. We know that ongoing tax audits were suspended during the lockdown. We also know that no new audits will start during the state of emergency. But of course, the suspension of ongoing audits and the absence of new audits go hand in hand with a suspension, like in any country, of statutes of limitations and procedure deadlines. So with this, I hand it over to my colleague Frank for Germany and the Netherlands.
Germany has put in a fairly general measure where taxpayers, if they can demonstrate that they are directly and not insignificantly impacted by the coronavirus, that they can actually apply for a deferral of taxes which are due or will be due in 2020 up to December 31st, 2020. So it's the definition is a little bit vague, but directly and not insignificantly is the language which needs to be shown to the tax authorities. It applies to all direct and indirect taxation payments, including VAT, personal income tax, and also local trade tax. It does not apply for payments cross-border in terms of withholding tax if you have royalty payments or interest payments. There, the withholding tax which is due on those payments would not be part of this deferral. Another thing which they have done in Germany, which is kind of in line with the overall objective of preserving cash for companies, that they have provided more flexibility in achieving carryback acceleration, which means there are losses which can go back in 2019 or 2020, which go back to early years. They can carry back earlier, which potentially reduces the previous year's tax, or even can result in actual cash refunds back. Another thing, which in itself is a completely different piece of EU measures, which we potentially should talk about in a separate session, is that there's all kinds of other payments. Just briefly on payments, Social Security bonus payments. Bonus payments up to 1,500 can be made tax-free for employees if they, for instance, provide, I would say, for US comparisons, like essential services. Social Security contributions deferral is only available if all other avenues are exhausted. So this is kind of the last resort. And just quickly, there is in Germany there are measures for commuter payments which go across borders, and they kind of provided some relief that because of the lockdown, people don't get into all kinds of taxable situations which normally they wouldn't if they would go across borders. And waiver of payments. There's one other thing I just want to briefly mention, which is not only in Germany, but also in other EU countries. There are all kinds of other non-tax related payments, which we should talk about it in terms of these are actually grants or subsidies for companies. And to be honest, if you want to be a startup company, you should probably move to Germany, and there's enormous amount of money available if you want to get that. But again, it's not tax related. Let's quickly do the Netherlands because I'm getting pink that we are going late. But in the Netherlands, first of all, there's no delay of filing dates as in Germany as well. There is an extension for 3 months for all taxes, but it needs to be done through a special request. An interesting feature, which is completely new, most corporate companies in the Netherlands, they file corporate tax returns quite late, and most returns have not been filed for 2019. What they have introduced now is that if you already anticipate losses in 2020 because of COVID, you can sort of show that loss in your 2019 return, which is not due yet, and again, either get a reduction of corporate tax payments or a refund. Penalty interest has been basically waived to 0, and some of the EU customs rules in terms of PPE and that kind of stuff is in line with the other EU countries. Again, as in Germany, on a non-tax related issue, there are enormous amounts of money made available for companies to kind of bridge and provide for salary payments for companies that have been impacted. And again, these are not actually loans like most in the US, but they are actually grants or subsidies. So quite lucrative, or not lucrative, but quite extensive measures which are outside the scope of tax, but still very valuable. Okay, I think that's my time on the Netherlands and Germany. So next.
All right, thank you, Frank. Very interesting comments, including on the losses. So Canada introduced a number of tax and non-tax financial measures. Many of the measures are similar to those described by Andrew, Laurent, and Frank, so I'll keep it high level. But on the financial side, Canada introduced a $73 billion wage subsidies program, and this program was recently extended through August. It's working fairly well, but it's complex. It's not user-friendly, so our clients often ask for assistance in that. So unfortunately, it's not as user-friendly as it should be, but it's working. On the tax front, tax measures to help with cash flow have been introduced. For example, payment of corporate taxes for 2019 have been deferred to September 1st. Remittances of sales taxes and customs were deferred through to June 30th generally. And CRA are expediting the payment of R&D tax credits and deferring their audits until later so as to accelerate payments. On the audit front, Canada is actually now resuming transfer pricing audits very quickly on the international tax audit side. It's not surprising because, of course, like all tax administrations, they'll be turning to multinationals to start recovering their monies and, covering their deficits. So CRA are prioritizing imminent treaty limits and statute of limitation. I heard earlier that in Spain, for example, statute of limitations were extended. In Canada, the statute of limitation is fairly long, it's 7 years. The problem is with treaty limits, which can be 5 or 6 years. So CRA are resuming their audits right now, irrespective of statute of limitations. As a heads up, the CRA will now start issuing 3-month requests for transfer pricing documentation. It's a bit of a catch because in Canada, you can automatically be subject to penalties if you have not responded within 3 months, given that by law, they have to send that request by registered mail and that offices are obviously closed. It's good to stay close to the large case file manager and make sure we know it's coming, etc. Of course, other aspects based on experience with CRA economists, they will be looking into limited risk arrangements, and for companies that can afford it, now is a good time to stand by and respect these limited risk arrangements if you can. Other aspects will include how do you who manages local risk under COVID? Are they global or local strategies? How are these things documented? These are the type of things that CRA economists and auditors will be looking for whenever they get to auditing 2020. So it's something to be thinking about. Domestic audits are much slower, and often the CRA will even accept to bypass certain taxation years like 2015 in the context of the crisis. Next slide, please. Quickly on competent authority and appeals, competent authority are resuming their activity. We do have APAs in progress, discussions between the European and Canadian tax administrations, for example. They're looking into how will they deal with 2020, 2021 as, for example, limited risk distribution arrangements, looking at the usual benchmark. There are discussions at the OECD level also with that. And we have to keep in mind that CRA now introduced a very strict policy on downward adjustments. So this year, it would be very important to, if there are transfer pricing adjustments to be made, to make them before year end or at least before the tax return is filed for 2019 and as well as for 2020. Appeals are progressing remotely, and the tax court, but the tax court is actually closed at the moment. With this, I guess I'll hand it over to Javier.
Thank you, Sebastian. So just briefly on some of the highlights of the U.S. measures, the corporate income tax extension has been from April 15th to July 15th. And that also applies to the payments of the federal income tax. States, it's varying state by state. I know California has complied with the federal extension, so July 15th applies to California, but in other states, check with the local rules with respect to when those filing deadlines might be and what extensions might apply. With respect to ongoing audits, the IRS has indicated that the ongoing audits will proceed, but without in-person contact. And for large business and international examinations, it will be business as usual for the time being with respect to the compliance assurance process, large corporate compliance, FATCA, and qualified intermediary programs. Next slide, please. With respect to new audits, the IRS has indicated that there will be no new audits currently unless the statute of limitations is expiring or the examination arises from taxpayer action. And also the LB&I auditors may expand existing audits to new tax years with manager approval. Auditors are permitted to work on new cases without opening an examination. So for example, audit planning, as long as taxpayer contact is delayed until after the emergency declaration is lifted. The IRS also made it clear that it will take steps necessary to protect all applicable statutes of limitations. So that's really the priority for the IRS in terms of when activity may resume or be extended with respect to audits. And with respect to tax controversy matters, the U.S. Tax Court has canceled all trial sessions through June 30th for now. Next slide, please. So with that, we'll turn to our next section on transfer pricing and practical considerations for applying the arm's length principle during an economic crisis. I'll turn it over to Sheena and Sven.
Thank you, Javier. And Sebastian in his section, as well as others, already touched upon transfer pricing and how relevant transfer pricing may really become during an economic downturn. So Sheena and I would like to here over the next 15, 20 minutes or so, spend a little bit of time talking about how does transfer pricing sort of and policies react or could potentially react in an economic downturn. And it's interesting, I went back, I've actually started in the field in the mid-2000s here, 2006. I went back and looked at some literature that was and articles that were produced by many colleagues around the world in 2008 and 2009 during really the last economic crisis. And granted, even though it was affected or very differently through obviously not a health crisis, many of these theories and many of these practical considerations back then may very well still be relevant today. And so if we move over here to the next slide, what we're thinking about doing and talking with you a little bit here is thinking about your supply chain and how it may be affected obviously at the big industry and M&E level. But what does that really mean in terms of maybe many of your routine subsidiaries? And should they, one way or another, be bearing some of the burden, right? Are there ways to be adjusting your transfer pricing policies proactively here in 2020? And one of the challenges obviously are, on the comparable sides, right? The benchmarking sides is the benchmark that the benchmarks we're using today may not be necessarily reflecting any of what's happening here in 2020. And so obviously important factors here as we sort of go through them is, yes, you've got to understand what is the profitability of your firm in a recession, what is that of in your industry, right? What is the behavior that your comparables are exhibiting in such a period? And then what are actions that can be taken? And so I'll turn it over here to Sheena. She'll walk you through some of these aspects on, what adjustments are there that could be made? What are advantages, disadvantages? And then we'll sort of take it from there and maybe answer even the question of, but can we even do that legally, right? Even though we may be thinking this is a great idea from an economics point of view, what's the legal framework of doing that? Sheena, I'll turn it over to you on the next slide.
Thanks, Ben. I'm Sheena Bassani, Barstow Lawson Nicole. I've been working in transfer pricing and international tax for over 20 years now. And obviously, these types of unusual times call for out-of-the-box thinking, and I'm very happy to have worked on this little presentation with Sven to help illuminate maybe some of the opportunities and ways to help mitigate tax and transfer pricing risk in these times of economic downturn and unusual economic circumstances. As Sebastian Rowe mentioned earlier, post-COVID, obviously the limited risk distributors and limited risk entities are going to be sort of put to the test to the extent that the whole point of being limited risk is to ensure a certain minimum profitability at the limited risk level. And in many cases, there's some cause for question as to what to do when certain risks materialize. So obviously the first question has to be, is there a need for adjustments in the particular case? And this is a question that has many layers, an onion with many layers, so to speak. And that inquiry could include starting out with understanding the relevant economic circumstances. So what is the impact of COVID, of the lockdown on your industry, on your group, your multinational group in question? And then we get down to the individual subsidiary under analysis. In most cases, we would expect that it would be pinpointing the particular risk that materialized at the subsidiary level, which would help illuminate the solution, and how, in fact, quantify the materialization of that risk might require some further analysis. When getting around to assessing arm's length parties' behavior, the arm's length principle being the measuring stick for transfer pricing between related parties, cross-border transactions between related parties. As Sven mentioned, looking at who contractually was obliged to assume the particular risk is definitely part of the inquiry, and as well as whether arm's length parties would have in fact agreed to that. In these very particular times of economic downturn, there's always the question of whether arm's length parties would have renegotiated the pricing on their transactions as a result of the materialization of the risk. Who is actively managing the risk and who's financially equipped to assume the risk? Those are additional questions that the OECD guidelines would push us to ask ourselves. Next slide, please.
Sheena, without too much interrupting your train of thought here, what if there isn't an intercompany agreement, right? I think we touched base upon this a little bit in our previous discussions. Obviously, none of my clients do not have intercompany agreements, right? But certainly, you know, it just happens, right? Or what if your intercompany agreement just doesn't address how risks should be shared? How will we go about this? What are your thoughts on that?
Yeah, that's an excellent question, and I think that this is also where a lot of the inquiry questions come into play here. Even without a written agreement, there's always an agreement, a verbal agreement between parties. Sometimes we can see evidence of what that verbal agreement would entail. And sometimes the risks are so exceptional that it becomes very difficult to see what, in fact, their intention was. Maybe they didn't think about that particular risk materializing, so you can't identify what the intention is. And in this case, probably there's other elements that will illuminate the discussion. And in many cases, between third parties, it wouldn't make sense for a party to assume the consequences of a risk if they're not the one managing it. So ultimately, you have to ask yourself, well, when it comes to inventory management, right, who's managing that? Are you just receiving product or are you making decisions on how much product you need? So if the distributor is the one managing that inventory, then there would be definitely a basis to conclude that inventory risk would be assigned to the distributor in that case. Thank you, that was an excellent intervention. So once we've arrived at an analysis of the background, understanding the backdrop there, and we see that there is definitely a negative impact on what's otherwise described or characterized as a low-risk entity, then the question arises, well, when would we adjust for that? So there's a few different options. Year-end transfer pricing adjustments are perhaps the most commonly seen. Those would be adjustments that are made prior to the fiscal year end, although they might be accrued throughout the year in some instances. The advantage of that approach is that the negative impact on the tested party is precisely quantified for the entire year. We see exactly what the impact of COVID or the lockdowns were on that particular entity and the business in the whole. The drawback could be that the benchmark comp data would not yet be available. So we put ourselves forward at December 2020. The benchmark companies typically would be December 31st companies. Their data is not going to be available for a couple more months, maybe 4 months down the road. So post-year-end transfer pricing adjustments are possible in many jurisdictions, not all jurisdictions. Canada is one where it is permitted. So that's after the fiscal year ends, but before filing the tax return. So on, I guess would be called a Schedule 1 adjustment in Canada. The advantage of a post-year-end adjustment is because you can actually wait until you do have that benchmark comparable data available, and the tested party data is otherwise final aside from any post-year-end transfer pricing adjustment. The drawback, however, in that particular instance is that the cash flow impact suffered by the subsidiary would be extended even longer. I mean, we're talking about COVID lockdown affecting the business probably as early as March, April. So waiting until a year later is perhaps putting a bit too much pressure on the cash flow. And that brings us to the relevancy of speaking about ongoing adjustments throughout the fiscal year. The advantages of that would be that it does resolve the cash flow impact at the source of the issue and at the concurrent time. It avoids interest on eventual loans and addresses the issues concurrently in a perhaps more convenient way as well too for the taxpayer. And as well too, there are some countries that are very averse or reluctant to accept the year-end, post-year-end transfer pricing adjustments. So obviously this would be relevant even more so for those jurisdictions. A couple of the drawbacks could be that of course, the 2020 benchmark comp data would be unavailable. And also the impact of the pandemic lockdown on the tested party is sort of in flux. We don't really know what the end result is going to be. So Sven and I are going to talk a little bit more about this last point, being ongoing adjustments. And when we first came together to talk about what we were going to talk about today, it was interesting. We kind of came at it from different angles. Sven came at it from the adjusting the comparable data angle, and I came at it from adjusting the tested party data. It's interesting to discuss and debate the two, but it's also important to understand that they're not mutually exclusive. So just to provide a sort of a little intro to the difference between these two approaches, adjusting the tested party financials, it involves identifying specific risks that would be assumed by the different parties or one of the parties. It would involve quantifying the impact of the materialized risk on the actual results of the controlled party in the transaction, so the benchmark party. There's also a question as to whether there would have been price renegotiation or amendments to the contract. So in adjusting the tested party financials, that could involve also some documenting of how you're arriving at that adjustment. There's a question of whether or not monthly billing or accruals would be the more appropriate way to effect the adjustments. And of course, a person would have to consider at what point in time is there going to be a reverting back to the pre-pandemic pricing if the pricing has actually changed. So I think I'll just flip it over to Sven to sort of give his little intro. We can flip to the next slide, and I'll get a bit more into particulars after that.
Yeah, and Sheena, you're absolutely right. I don't think that either one of those approaches are mutually exclusive. I think they really depend on the fact pattern. Obviously, my point of view is the better one, using or looking at the comparables. But all joking aside here, they both have their advantages. And focusing on the comparables is an interesting one, in my opinion, in that it is focusing on data that is publicly available, right? So the taxing authorities could be doing sort of the same and are able to reflect upon what you have done to the comparables. And when I say comparables, what I really mean, again, when you do your transfer pricing on a proactive basis, right, then your comparable companies' financial information is at least 1 year old. So they're not going to be reflecting anything of the shenanigans that are going on right now in the world on the economic side. One way of really looking at this, of trying to adjust your comparable set to be reflective of some of the financial or economic conditions, is you can rescreen them. But again, the data, the point of data the framework, the data, the time frame was not going to change then. What I actually do find relatively intriguing, and there's articles about that, again, we talked, or I mentioned it before, the 2008-2009 framework, is you look at your same set of comparables or a comparable set and look how your comparables behaved during the last recession. And if those are routine companies, it is quite interesting to see, and I've looked into this with other clients before, you will see even on the routine company side, quite a substantial impact on their financials, right? And so it has its benefits using some of tried and true measures, yet looking at a different time frame and using some other adjustments to see what should your routine companies, what are they benchmarked against using same or sort of similar set. What it doesn't have, and this is where I can totally appreciate the other side of, hey, we'll leave my comparables alone, but we are sort of normalizing the tested parties. You have maybe a little bit more flexibility, and it allows for a lot more of a refined approach, as Sheena will talk to you about here in the next few minutes, and what risks are reflective on the financial statements of your tested party that you could adjust for, so you would sort of normalize it, if you will. Sheena, I'll pass it back over to you.
Yeah, and I think we can see that there is innately some overlap between the two. Either can impact, for example, the day-to-day policy, the pricing that you're following. Either approach can affect that. In what you were just saying, one thing does pop to mind, obviously, which is that one disadvantage of adjusting the comparable data is that the comparables are not always routine comparables. So I mean, think you and everybody, we've all seen comp sets where, yeah, they seem to have routine returns, so we tolerate them in the benchmark set, but they actually are exposed to significantly more risk than what the tested party is exposed to. So, so the impact on those might be bigger and might be challenged in that respect from the tax authority perspective. I would say that overall, the advantages of adjusting tested party data as opposed to the comparable data, or in addition to, is because those adjustments would be more specific. You can rely on specific contractual clauses to support the adjustments. They're easier to understand in that respect and don't rely on statistical measures or regression analysis. Not that that's a hard to understand calculation, but I think that if we take an example of a limited risk distributor, for example, let's say in these troubled times, there's a lower volume, so there's less sales to cover the fixed costs of the business. And that could be a risk that should be assumed by the distributor. The higher OPEX costs, on the other hand, let's say that there's additional warehousing that's required to store the buildup of stock, that could be a different result. Maybe following the inquiry, we find out that it was the headquarters that made the decision to stockpile more product at the local sites. But also, again, as Sven mentioned, what does the contract say? Are there minimum purchases in the contract? Maybe that is something that would have been assumed by a distributor. Obsolescence, again, another materialized risk a limited risk distributor could be suffering. Is that exceptional? What would arm's length parties have done in that case? What would they have agreed to sharing of that or not? Bad debt, on the other hand, if limited risk distributor, if they're the ones responsible for reviewing the credit worthiness of their clients or customers, then that bad debt risk could very well belong with the distributor. So in that case, instead of saying, well, we're at a loss because of all this bad debt, how do we modify the range so that we're still in the range even though we're negative? What you're actually doing is saying, okay, the bad debt, it was $10 million. The distributor assumes that if we adjust that out of the financial analysis, we're still in the range of what's left. So we still have a positive result, after adjusting this particular risk. So, so as you can see, you can still use the benchmark range even when you're adjusting the tested party, which is, I think, a major advantage as well too. And it doesn't rely so directly on the comparables, which in many cases could end up going bankrupt or undergo significant business change before the year-end benchmarking study is completed. So on the other hand, there are some disadvantages. It's not always possible to perform adjustments on the tested party data. And one particular instance of that could be if it's not possible to see what the corresponding amounts are for the comparable data in the 10Ks and the financial statements, then you could end up with an apples to oranges comparison if you're adjusting one and not the other. Turn it back over to you, Sven.
Yeah, and we have a very diligent moderator here, and he's been pinging me. It's like when you look at the news shows, you got 30 seconds to go, then I got to go on a break. So I am asked to transition here. In a nutshell, I think what we wanted to do here with this session is really stress the importance of looking at your transfer pricing policies proactively. Whether you end up making adjustments, whether it is feasible to make adjustments or not, aside, but there are ways to preserve or manage your cash flow during this period of time using transfer pricing. And if you can couple this with a sound methodologies of doing so, and your intercompany agreement supports that, or your intercompany agreement can be amended to support that, then this is certainly the time to do it, given that we're in May of the year and there's still room to do that. So I'll transition it over here to the next session, and we'll take it from there.
Yeah, and just to tag on to that, obviously transfer pricing risk exposure may not be your number one concern if this business disruption is severely affecting your business, but asking those questions earlier leaves more options to mitigating the potential risk exposure and evaluating both beneficial and detrimental tax impacts that have an interplay with that.
So we've just talked about functions, testing of risks, intercompany agreements. Do the risks and really sit where we think they do based on the underlying contracts? This section is more about and the movement of people. And this current time is an incredible event in terms of the impact on the individual, on the person. And there's a lot of commentary about that in the UK, that we have restrictions on movements which we didn't even have in wartime. And in terms of people not being able to get to where they want to be or would expect to be. And in terms of the tax impact or change in the tax analysis on a business, this really splits into three different sections. The first one is permanent establishment, which we commonly think of as being a fixed place of business. Well, people do business, right? Business usually means people doing something. Certainly the areas where permanent establishment is perhaps not clear or is subjective will be around where people are and what they're doing. The second is residence status of both companies and individuals. Well, that depends on where people are and what they're doing. Perhaps at a higher level than PE, it's a more permanent concept. And then the third is cross-border working. So generally, it is where someone is physically present, where they're performing some kind of duty, which feeds into what their employment tax status is. So those are the three areas where the place of the individual is really important. So we've got some examples in the next few slides based on our own clients and conversations we've been having over the last couple of months about problems which have arisen because people can't get to where they expect to be. And then we'll move on to the fact that, fortunately, there seems to be some recognition here. The OECD has published some recommendations around these impacts. But of course, these are recommendations. They don't equate to binding law for local tax authorities. So we move on to some country-specific comments around how those recommendations are feeding in. And then also to the practicalities around what profit you should attribute to a PE if people are doing things in different places. So it may not change the analysis. You may or may not have a PE. You may have a PE already. You may know that, but what people are doing in specific locations may change, and that may feed into a different analysis of who's doing what where. So permanent establishment, what does that mean? Well, we all know that it's really the concept of trading in the relevant country rather than trading with the relevant country. And not every transaction that you might have with another jurisdiction will be caught and create a PE. That's clear. But equally, you shouldn't be able to sidestep local taxes by setting up an entity outside of country B. So there should be some rule that says if you incorporate or you're trading through an entity in country A, doing business in country B, you should be caught and pay some tax there. And the way this has evolved is there will generally be some kind of local law as to what activities are within the scope of local taxes. In the UK, we had 150 years of case law that developed us to a point where we needed tax treaties with our jurisdictions. Eventually, the OECD harmonized some of the wording of those treaties, so they're fairly similar. And then in the UK, it's only very recently that 150 years of case law has been coded into clearer legislation. And there is obviously some subjectivity around what is or isn't a PE. And the OECD definition of most treaties start off with a definition based on a fixed place of business. And that has its widest meaning, although then treaties will go on to exclude some activity, so preparatory or auxiliary nature, just maintaining a stock of goods. But then there are some other activities which create a PE which you may not think of a fixed place of business. So if you perform some activity on someone else's building site or construction project, or if you don't have a presence in a country yourself, perhaps you just have an agent there and you think of that agent as being something separate to your business because it's a different entity, a different part of your group. And all of those can obviously be affected if people can't move to where they want to be. So taking the most obvious example of a construction site, what if you had a piece of work that you expected to take 5 months, but you've had to shut down for 2 months, so it's now going to take 7 months. So if in your particular tax treaty, generally they're framed around a period of 6 months or 12 months, those seem to be the benchmarks. So if we're in a scenario where it's 6 months, well, you've gone from 5 to 7, you've tripped over the limit. So what does that mean? The other area of subjectivity, great subjectivity with PEs, is home office. Perhaps you've got a scenario where you've got your first foray into another country and you've employed one salesperson and you haven't got an office yet. Then you'll know that it becomes subjective. Do you have a PE yet or not if they're working from home? And what we're finding at the moment is that there's an enforced scenario where our clients have people working through home offices perhaps in different jurisdictions because they have ended up in a different jurisdiction to where they're expected to be. And a home office, it's clear, a home office can create a permanent establishment. Perhaps you need a degree of permanency. Perhaps you need some other facets like the host entity meeting the costs of maintaining that home office. And perhaps you need something more than just a home office and with clients visiting or meetings taking place there. But it's, again, certainly the case that different jurisdictions interpret that in different ways, and that having a home worker creating their own home office in their own home can create a PE for your business. Okay, so move on to the next slide, and I'll hand over to Andrew, who will talk about the resident status of companies and how the location of individuals can impact on that.
Thank you, Steve. And I'm glad you introduced PE so well, because that's a very, very complex issue. And I'm aware that in certain jurisdictions, Spain definitely one of them, tax authorities are eager. They go in and try and look and grab and create permanent establishment. So it's a very delicate situation for multinationals investing and operating cross-border. So definitely something to keep in mind and analyze. So now we're going to go into resident status, both of companies and individuals. Also super interesting. Again, as Steve was saying, even though we're talking about companies, we always have to think of the people that are behind the companies. And because of the people, we have to think of global mobility and the impact of this current lockdown of the COVID-19 crisis. So when do we have to analyze resident status of companies? Usually a company is incorporated in a jurisdiction. It has its domicile in that jurisdiction. So we can consider that company resident in that specific jurisdiction. However, each country has its own domestic legislation, and each country defines how a company is considered tax resident. And we could be in a situation where, because of domestic law, a company is tax resident in two different jurisdictions. When that situation happens and a double tax treaty exists among those two countries, we go to a tax treaty, and luckily the tax treaty envisages a tiebreaker rule. Basically, it grants the authority of taxation, it grants the taxing rights to the country where the place of effective management of the company lies. So again, let's put a situation where, for instance, a US company that could be incorporated in the US, but for domestic internal UK laws, it could also be considered tax resident in the UK. So we have a company that has dual tax residency. So we would have to go and analyze where the place of effective management of that company is. What does effective place of management mean? Again, this is a case law situation. Also OECD commentaries on the convention, on the treaty models. These are not mandatory and binding guidelines, but yes, they are soft law and they do help as guidance to try and define where the residency is. What we understand for place of effective management, board meetings where the senior management takes and deals with the day-to-day business, where strategic and commercial or management decisions are taken. So this is very important, and nowadays when people, senior managers, executives, board of directors are locked down in their home country, they're taking these board or top management decisions in the countries that they're locked down in, and we should be careful because this could generate that the residents of that, the formal residents of that company that is in one jurisdiction could be moved on to a jurisdiction where that senior management or board of directors are taking the decisions. As we'll see in a couple of examples, how we can try and navigate through this situation. If we can go to the next slide, please, where we're going to be discussing the resident status of individuals. Here again, individuals can be considered under domestic law of different countries tax resident in different jurisdictions. That's when we have a conflict of residence between two or more jurisdictions. Luckily, again, if among those countries there's a double tax treaty signed, a bilateral, the tax treaty has a certain cascade of tiebreaker rules, meaning that we should first analyze the first tie-breaking rule. If this does not apply, then we go to the next one. And these are the images that we included in this slide. The first thing that we have to analyze when an individual is tax resident in two jurisdictions is, number one, see in what jurisdiction that person has a permanent home available. Sadly, or unfortunately, in a lot of situations, people can have homes to their availability in two jurisdictions. I'm thinking, for example, of a family that can be living in France, but one of the spouses, one of the parents, works 3 or 4 days per week in London, in the financial district. If we had if under the UK and French domestic law, that person were tax resident in both countries, we would go into a double tax treaty and see where that person has a permanent home available. If it has a permanent home in both countries, we will skip to the next rule. Where is the center of vital interest of this person? This includes both economic issues, but also family ties. Where is the spouse? Where are the kids? Where are the friends? Where is the job? Is he or she member of any social club, etc.? Again, if we cannot decide if this person has center of vital interest in both jurisdictions, we would have to skip into the next rule, which here we name it as habitual abode, and we draw a calendar. Basically here what we have to see is how many days is that person spending in that specific jurisdiction. If with this rule we cannot decide where he's resident, we would have to go into nationality. And in last case, if we cannot decide among any of the previous rules where this person is tax resident, there would have to be a mutual agreement procedure among the two countries that are trying to fight for the residence of this person. Worst case scenario could be, sadly, but we must say this, there can be cases of effective double taxation where the countries just do not agree in the final residence.
The next couple of slides talk to those real life examples I mentioned where we're seeing issues. One I mentioned was movement of people being in jurisdictions where they don't expect to be, with borders being closed. And this slide just really crystallizes the scale of that and how many people must live in one country and work in another. So 88,000 workers go each workday from France to Luxembourg, and given the nature of that jurisdiction, it's reasonable to assume that they're office-based people who are probably still working from home, therefore carrying out duties in a place, in a jurisdiction, in a country they didn't expect to be, perhaps making decisions there or concluding contracts there if they're salespeople. So that talks to those points I made around permanent establishment. Perhaps you've got people concluding contracts from a home office in France when they would normally be doing that from Luxembourg, and also employment taxes. They're now performing duties in jurisdiction of France rather than Luxembourg. I mean, if you look at my example, I commute into the office. I commute in about 30 miles from home to where I work. I was working in London before, where that was more like 70 miles. Obviously, I'm working from home now. It's quite feasible to think that people travelling those distances are crossing a border to do so. And I imagine that it's the same in the US along your borders with Mexico and Canada. So this slide, I think, just crystallizes the fact of this concept of people perhaps working in the jurisdiction they wouldn't normally be. And if we go to the next slide, again, this is a real life example of one of my clients who's asked me about this issue. They have people in Spain, they have people in France, they interact, people from the UK get involved in those businesses and travel out and get involved in those businesses. People in the UK that support the French sales team might be getting involved in sales from the UK that they would normally do on trips to France. Spain, there is some movement across the borders. So, you know, we've got a real life example where that movement of people, an inability to do that is causing a problem. And then the third example I've got on the next slide, and again, this is a real example of corporate residency. So I have a client, they maintain residency of their company outside of the UK and take steps in accordance with HMRC guidance to do that and make sure their decision-making process is offshore, but that involves them traveling offshore to board meetings. So what do? I mean, they still need to run their company, right? And they can't get out of the UK. So how do they deal with wanting to have their central management and control outside of the UK? They can't temporarily stop central management and control happening. And then also they get involved in, have board representatives on the boards of their subsidiaries in Canada and Luxembourg. So they can't get out there to have those meetings. They have those meetings virtually. What's the place of a virtual meeting? I mean, in the UK, it's generally considered to be where the person chairs it from. But if the most decisive person in the decision-making process is probably the UK representative of the parent company, does that mean central management control is reverting to the UK for those subsidiaries? So I think we've got some issues to manage, certainly. We're having a lot of questions about it. And then, Andrew, I think you've got another example.
Yes, we're going to go through it really quick. Fairly famous celebrity that unfortunately was filming in Ireland and got locked down with his family there. And we just wanted to illustrate this example because here we could have different problems. We could have conflict of residence of the individual, in this case, the actor. We could also have, because this actor, probably a wealthy person, probably has his own corporate structure. We should see if eventually the structure, the holding company, whatever, could be effectively managed from Ireland, and therefore we would have a change of tax residency of the company. Or if not, we could maybe discuss if this actor may be assigning contracts, etc., in Ireland, and that could eventually generate a permanent establishment. However, again, as Steve well explained, there has to be maintenance in time and ordinary doing of business. So as an exceptional situation, this should not trigger any of these tax situation. So the idea is, how do countries react with these situations? What happens when one of your employees, management team, etc., are locked down in a country or a construction site, and we are entering into a problem of permanent establishment, residency test? Each country, as we'll explain later, some countries have adopted specific measures. However, at an OECD top level, again, not binding, but should be considered as interesting guidance in soft law, the OECD has come up with certain recommendations on how to handle with these situations, basically saying that, again, under the permanent establishment, be it home office, the dependent agent, or the construction site, these locked down days should not be taken into consideration when trying to assess and determine the existence of a P. So in that way, they are recommending for the countries to agree on, let's take this as extraordinary days. Please, let's not have harsh tax measures because of this involuntary lockdown. Next slide has to do with residents of the companies, individuals, and the cross-border workers. In the end, the underlying idea is the same. These lockdown days should not be considered for P status or resident status. And with this, we pass it on to Javier, if I'm not mistaken. So we go and analyze the country specifics, what certain countries have done regarding these matters. Thank you.
Brief comment about the US guidance recently issued. In a frequently asked questions webpage, the IRS indicated that for non-US businesses or non-US residents that are in lockdown within the US, typically that could generate a taxable presence and subject those entities or persons to US tax. But the IRS has indicated that there is a 60-day period under which a person or a company could have a presence in the US and will not be counted towards establishing a permanent establishment or taxable presence. And the company does have to specify that in its documentation. It should maintain as a best practice that indicating that that's the time in the US was because of COVID-19 travel disruption. So any correspondence that could document that, information on canceled flights or other restrictions on traveling back to the home country, that would be helpful to establish that that time period should not be counted towards creating a taxable presence. The IRS also indicated that this time for looking at the 60-day period has to start sometime between February 1st and April 1st, 2020, and it's up to the entity, the company, to actually choose the start date. So there's some flexibility there. And again, just the need for contemporaneous documentation to have a position on what a taxpayer would present to the IRS if questioned. Next slide, please. There's also recent guidance from the IRS under Revenue Procedure 2020-30 with respect to inbound transactions or non-US businesses having activities in the US. That was with the 60-day period I referenced, but the RevProc here that I mentioned specifically talks about outbound transactions or US companies having activities in other countries. There's a compliance requirement on Form 8858 if a US company has a foreign branch, so a lesser threshold than a permanent establishment. And typically the Form 8858 would be part of the US return. But the IRS has indicated that if there is a temporary business activity in a non-US country due to COVID-19 travel disruptions, that a Form 8858 will not be required. And it goes the same for, say, employees of a foreign or non-US subsidiary of a US company. any potential branch establishments due to COVID-19 travel disruptions will not require the Form 8858 as part of the return. And similarly for non-US partnerships that may be created from arrangements taking place, the Form 8865 will not need to be required if specifically a result of the COVID-19 travel disruptions. Next slide, please. So now I'll turn it back to Sebastian for some Canada-specific guidance.
All right, thank you, Steve and Andrew and Javier. As the talented Mr. Ripley, I hope that Matt Damon will be able to navigate through these complex rules. So, but in Canada, most of these issues will be as between Canada and the US, obviously, but we do have a lot of situations involving Europe, as you looking at the example that you just presented. So it's important to get clarity. Unfortunately, CRA took forever to issue their guidelines. They finally published their guidelines this morning. We haven't gone through it in detail, although it's not very long. The long and short of it, I think, is as the saying goes in advertising, the large print gives it away, but the small print takes it back. So, for example, CRA will not consider a non-resident entity to have a permanent establishment in Canada because its employees perform their employment duties in Canada. If this is solely as a result of the travel restrictions being enforced, and so solely is quite restrictive. There are nuances in PE analyses. We'll have to see how that evolves. Same thing for dependent agents. There will not be a PE provided that the agent's activities are limited to that period and would not have been performed in Canada, but for the travel restrictions. It sounds good at first glance, but again, in practice, we'll have to see how the tax auditors deal with that, and it might create some areas of controversy. So I guess we're on the next slide now. So in terms of the consequences of determination of a PE, there's in principle and then there's in practice. In principle, the crisis should not result in negative impacts on PEs. First, you probably don't have a PE based on the administrative policies, subject to what I just said about the fine print and how the auditors will be implementing that. Secondly, in principle, a PE does not in itself mean that significant profits of the non-resident are taxable in that jurisdiction. Some activities are exempt, as we've seen earlier, and the level of income depends on the functions and risks of an asset of the PE in the jurisdiction, which comes back to a transfer pricing analysis. So not necessarily, although the analysis can be tricky. And thirdly, if material income is taxable in the PE's jurisdiction, then of course you have relief, potential relief under the mutual agreement procedure if there's a treaty in place. On the next slide, we wanted to conclude with a few comments about what happens in practice. In practice, what is temporary? How long will the effects of the COVID last on the operations of the multinational enterprise? Will some behavior be continued after the crisis, or after what the government believes was the end of the crisis? Administrative policies are not law, certainly not in Canada, just like the OECD guidelines on transfer pricing. So auditors will be tempted to dance around these things to some extent, and if they can attach other factors to their case, they might try to leverage some of these special circumstances in their favor. So it's important to think about mitigating PE risks now. Each case is different. There's no sort of a blanket recommendation, but obviously making sure that resolutions, minutes, correspondence are prepared in 2020 to validate and document the intention, the preparatory or auxiliary nature of the activities, or a lack of power to bind the principal, that sort of thing. And in some cases, it may be prudent to file a non-resident tax return, certainly in Canada, or obtaining waivers on the obligation to withhold tax on payments for services rendered by non-residents in Canada under Regulation 105. So there are a number of things that should be thought about in terms of mitigating risk as opposed to just relying on these administrative positions being released by various tax administrations.
Yeah, if I may, I want to add one point on the Dutch piece. When we talked about these grants and subsidies for employees that which are in the Netherlands, that also applies to a foreign company. Say you have a UK company who's got some Dutch employees without having a Dutch entity. Those grants and subsidies are also available for that UK company to keep these people on the payroll, even if it's not a legal entity in the Netherlands. So that's kind of an addition to what's on the slide as a general point. So it goes a little bit further than at first face value if you look at those measures.
And on the transfer pricing side, but just to wrap up maybe a few comments, we were going to get into some practical examples, but we ran out of time there. But some of the elements to look out for in your business to ask those questions about whether or not your transfer pricing may need to be revisited. Has there been operational changes? Has there been a shuttering of any facilities, any transferred production or other functions transferred out of the country? Massive store closures, severance pay, who's paying that? In cases where there's intercompany loans, there might have been changes to the credit ratings of the parties that would impact the pricing at renewal. Relocation of risk management function. As we know, oftentimes the who's managing the risk is determining who's assuming the risk. And so if that risk management function shifts to another country, it could shift the characterization. In many businesses, even ones that are doing really well during this time, they're offering significant discounts or credits to clients who've seen them through some of their learning curve and meeting the new needs. There might be, even post-pandemic, there's going to be possibly heightened requirements for Made in America that could have an impact on manufacturing in Canada or elsewhere. So these are some of just a few examples of things to look out for.
Yeah, another point maybe with negative interest rates. In North America and Canada and the US, of course, we're not as used to seeing that, but we've been getting more and more questions about them in a context where some of our clients are based in Europe and are looking to repatriate cash in the form of cash pooling arrangements or loans. And so the deductibility of negative interest rates from a Canadian standpoint certainly is not clear. It also raises a number of transfer pricing issues, which I know Sheena and others, I'm sure on this call, have been considering. So that may be something that we'll be unfortunately seeing a bit more over the next year.
I would like to add, especially now that we went through this, probably the peak point, depends obviously on the country, but probably the peak point of the crisis has already been by in certain jurisdictions. And these imminent and immediate measures that had to be taken in place in each jurisdiction for tax purposes. Maybe after this point, it's good time to maybe think a bit more mid to long term. Obviously, transfer pricing is huge, and having that documentation that backs the new transfer pricing structure, and also eventually changes that have to be done within the group, be it through mergers or any type of restructuring, and maybe trying to apply special regimes, be it the tax group regime, if that is feasible in a specific country or not. But again, thinking probably now mid to long term. Obviously, nobody has a crystal ball, but we can try and see what the projection of the activity in each business is going to be, and probably try and plan with that in mind, with a more of a long-term vision.
All right, thank you, Andrew, and thank you, everyone. Looks like with that, we can wrap up the webinar for today. I want to thank all of the panelists for their contributions and preparation of today's webinar, and for the audience for your participation. As you'll note in the slide deck, we've included our email addresses, so feel free to reach out to any of us with any questions you may have. And as you note, there are specific countries we've focused on for today, and that's simply a decision to for time restriction purposes. But if you have operations or questions with respect to any other countries that were not specifically discussed today, again, please feel free to reach out to any of us, and we'll be able to involve the right people from our respective teams to help you on those questions as well.
Thanks, Javier. That was excellent working with you. You were a great facilitator for this panel. Thanks.
Thank you, Sheena.
Thank you.
Thank you, Javier.
All right. Thanks, everyone. Have a good rest of the day or a good evening. Goodbye.
Thank you, everyone. Bye-bye.